Dan Passarelli of MarketTaker.com, here on the floor of the CME Group. Well, one of the trades we talked about today in our Market Taker Live Advantage Group coaching class was in Twitter. Take a look at a chart of Twitter. Over the past 6 months, Twitter had a pretty precipitous drop. However, over the past couple of weeks, Twitter's been making somewhat of a comeback. The stock closed above 35, which is a previous resistance level, and now that level becomes support. The stock has some room to run in the short term because the next resistance level is the 50-day moving average, which right now is up at about 38 bucks a share. That's about 8% higher. So I like playing Twitter from the bullish perspective in the short term, maybe about a 1-week trade. But the question, of course, becomes, well, how do I trade it? Here's the trade that we talked about today in our class. Buying the July 35 calls for 240 or better. Now, this trade has some advantages for a couple of reasons. One, the higher the stock goes, the better. There's no limit on profit potential on this trade. So even if the stock breaks through the 50-day moving average and continues to run, this can be a pretty leveraged, nice spec play. The call is in the money slightly, so therefore the delta is pretty big. It's above 50. So the stock moves pretty well in step, the call moves pretty well in step with the underlying stock. Another thing, the implied volatility is below historical volatility, and implied volatility in many stocks right now is very, very low. So you can pick up these calls for pretty cheap right now. That means a couple things. That means lower total risk because the trade, I can only lose what I put into the trade, and I'm putting in less than I otherwise should because the volatility is so low. And for as long as I hold that trade, of course, I have time decay that works somewhat against me. Because I'm paying less for the call because the volatility is so low, the time decay becomes a little bit lower too. So I'm punished less for holding it. I can probably afford to hold it for an extra day or two to hope this trade works out. Now, as far as management goes, if the stock gets up to the 38 level, that 50-day moving average, I probably take off half of this position and maybe continue to hold the rest to see if it pops above 38, because then the stock can really make a pretty good momentum play. If the stock ends up falling, going against me, like I think it won't, but it could happen, I would have a stop in place. If I pay $240 for this, I'd probably allow myself to get stopped out at about $1.90, no more than that. So I basically risk 50 cents as long as my stop holds. This is Dan Passarelli of MarketTaker.com, here on the floor of the CME Group.